Good evening. My name is Asaf Pinchas, and I'm partner here at Allegiance Financial Group Advisory Services. Along with my other partners, Sean Williamson and Charlie Cook, as well as the rest of the team here at Allegiance Financial Group, I'd like to welcome everyone to this evening's webinar, and thank you for taking time out of your busy schedule to join us. I want to start with some housekeeping items. In a webinar format, all participants will be muted, and your video will be off for privacy reasons. This webinar is being recorded and will be available for replay. We encourage you all to go to the full screen mode so you can see the material that will be shared on the webinar. We also encourage questions through the Q&A box. We will monitor them and pose them to the speaker as they come, but only the panelists and hosts can see the questions for privacy reasons. If we don't get to all the questions, we will follow up directly after the event to answer them. At Allegiance Financial Group, our approach to wealth management is very comprehensive, as many of you know. We strive to help our clients achieve what matters most to them by not only helping them manage their money, but also partnering with other experts such as attorneys, tax experts, and investment experts to help our clients with advanced planning areas such as making sure that their loved ones are taken care of, protecting against potential risks and liabilities, and mitigating taxes. One of the firms that we partner with is Dimensional Fund Advisors, which is one of the premier investment managers in the world, managing close to $800 billion in assets. Our speaker today, Apollo Lupescu, is a vice president with Dimensional. Apollo is a globally recognized speaker who has delivered hundreds of lectures and seminars to financial professionals and individual investors on various investment topics. Apollo began with Dimensional in Santa Monica, or has been with Dimensional in Santa Monica for over 20 years, and prior to that, he taught at the University of California. He received his PhD in economics and finance from UC Santa Barbara, and he also holds a BA in economics from Michigan State University, where he also competed and coached in water polo. We hosted a webinar with Apollo about a month ago before the election, and it was extremely well received by our clients. We weren't able to get to all of the questions, so we decided to have Apollo back for a follow-up webinar. So without further ado, I would like to introduce Apollo Lupescu.
Well, hello, and again, thank you so much for the invitation to come back, and thanks to everyone who's taken the time this afternoon to join. I'm really excited to continue the dialogue that we started not too long ago.
Thanks, Apollo. I'm going to start with the first question. Being that we, just got past the election, it was an exhausting and divisive election season that's now behind us. And roughly half of the country is fearful about the future. The other half is excited about the opportunities ahead. And there's no real clarity yet about which campaign slogan the promises will make their way into actual policies, such as tariffs or tax cuts. But what are some of the implications for the market? And do you think investors should make any adjustments?
Yeah, no, and you're absolutely right. I mean, it's just taking shape a little bit what the lineup in the new administration is going to be. And I want to go back to something that I kind of mentioned during our last podcast, because that element is still valid today as it was back then, which is that as you said, you are looking at a client's circumstances, their needs, their risk capacity, all these elements that are make every single person, every family unique. And you're crafting a financial plan. And that financial plan has two fundamental pillars. One is ownership in companies, and the other one is lending money at specified interest rates. And these two types of investments are impacted quite differently by what's been happening since the election. So I'm going to touch on both. But I want to start maybe with something that instead of looking at the stock market, which is about ownership in companies, it might be worth starting with looking at bonds and what's going on with bonds right now, because bonds are that form of lending that is available to all of us. And what exactly is a bond? Well, let's say the U.S. government needs to borrow money, and we know that that's the case. And when the government needs to borrow money, instead of going to a bank, they come to us as investors and ask us, hey, listen, would you be okay lending me, let's say, $1,000? And if you do that, then we're going to write up a contract. And in that contract, we specify a certain interest rate for how long you get that interest rate. And at the back end, you get your money back, the principal, the $1,000. And that is appealing to a lot of investors because if you deal with the US government, which has never missed an interest payment or principal repayment, you feel relatively safe. You say, well, that's a pretty good deal because I know exactly what I'm going to make on my money for how long, and I'm not really at risk of not getting my interest or principal based on the historical track record of the government. So a lot of investors are very intrigued by this opportunity because it provides a little more certainty about what's going to happen to the money. So the reason I want to start there is because as the election unfolded, and even before the election unfolded, the markets were really expecting a win by the Trump campaign. So when that happened, the markets and particularly the bonds, they're really looking and saying, well, if this candidate is elected the way we expect based on polling and everything else, then and the propositions and the proposals that he's suggesting, what are some of the things that could happen? And there are a lot of proposals. Nobody had exact clarity, but I would say that a couple of them really jumped out. And one of them was this idea spoken over and over that perhaps we're going to have tariffs. And once we put tariffs in place, what's going to happen is the companies importing importing the goods are the ones paying for those tariffs. And ultimately, what economists have found over and over is that these tariffs they end up being passed to consumers and prices go up. So that's something that has been shown in the data, and it's been pretty well documented by the economists. So to understand what the impact is that in a bond, if I'm going to lend my money to the U.S. government, let's say for a number of years, the first thing that I want to make sure is that at least I get my inflation back, because I want to make sure that that hurdle is clear. I'd like to at least make sure I stay ahead of price increases, so I'm not worse off. So anytime you look at a bond interest rate, one of the cornerstones of that interest rate is the expected inflation rate. If expected inflation rate is going to be, let's say, 5% per year for the next few years, and I'm only going to get 3% of my bonds, well, I'm behind the eight ball. I'm not even, going to keep up with inflation. That's not right. What bond investors want to do is at least stay ahead of inflation. So one of the things that we've seen as the election was unfolding was this expected inflation over the next few years actually started to change. And there's a metric that the Federal Reserve actually keeps track of, which is called the 5-year break-even inflation rate, which looks at, when you look at market participants, what do they expect inflation to be on average over the next few years? And that is based on the way that they price different types of bonds. Some that are covering for inflation. So there are some type of bonds that automatically give inflation and some that don't. And based on the way they're priced, the markets have been very, very clear, and traders are very clear onto what the market is pricing it as the expected inflation. So I'm going to share with you the live website of the Fed. And if you look at this website, and I'm going to zoom in a little bit, so it becomes more clear. But if you go back to well, let's do the 1 year numbers. So if you go back to September, and this is when the debate happened, and it was obvious that there are no major dynamics that are likely to change. And I'm not here to do politics. It's just more like the market and what the markets are reacting to. At the time, the expected inflation on average over the next 5 years that was priced in these bonds was about 1.86%, so a little below 1.9%. As the campaign went on and there was a realization that this train is going to move in that direction and nothing's going to change, what's happened over the past few months is a couple of months is that as the election unfolded, this particular metric of the inflation expectation over the next 5 years has increased from about 1.9 to over 2.4%. So about 0.5% increase on average per year over the next 5 years. That's been the change. So it went from 1.9 to 2.4 as being sort of the baseline the baseline inflation. And how that impacted is, for example, if you look at bonds that are 10 years in nature, and again, the Federal Reserve publishes the data, what you see that's quite interesting is that over the past exactly the same period, these interest rates on US government bonds have increased from about 3.6% to about 4.4, which pretty much tracks spot on the inflation changes. So the first thing that I can tell you that a lot of folks, and there's not like something written in stone, but at least what the market's really looking at is that the one thing that's changed is the election, and the expectation for inflation has increased. And once the expectation for inflation increases, at that point, so does the interest rates on these government bonds. And why it matters to you, to all of us, is because this 10-year interest rate that I just shared with you is also not only important to folks who might want to lend money to the government, but it turns out that that 10-year treasury tends to be very, very, very closely aligned with the mortgage rates. And that's where it gets interesting, because over the past few weeks, again, going back to September and that debate, what you're seeing is that the inflation has increased by about 0.6% or so. That's been the increase in about 0.6% increase in inflation. Which has led to a 10-year increase in interest rates of about 0.6%, which has led to the mortgage rates going up over the past few weeks by about 0.6%. So the mortgage rates went up from about 7.2 to about 7.8 today. And then to me, like it's one of the possible effects that we're seeing post-election. And again, I don't want to say that all this is due to the tariffs, possibility of tariffs. It's just that markets tend to be forward-looking. They're trying to anticipate, and what they're seeing is that basically some of these policies, if implemented, including larger deficits potentially, if you have tax cuts and no spending cuts, well, no clear spending cuts, then obviously you're going to have to borrow more, which might lead to higher inflation as well. So long story, the one impact that's pretty, like I wouldn't say that everybody agrees on, but I think it's in the data, is that the expected inflation has increased, the rates on government bonds have increased, which have also led to the mortgage rates going up. And where I go from here depends on what actually gets implemented and what doesn't get implemented. Now, what about the stocks? What about companies, and how will they be impacted by these tariffs? And this is a very interesting area, because typically what you have is a situation where consumers tend to get the short end of the stick. They're the ones paying more. And again, that's what pretty much all the economic papers are showing. Some companies get some short-term protection, and that's something that could benefit them and maybe benefit an industry. It's just not clear that necessarily translates in investment success. And one of the examples that I think we talked about was U.S. Steel, because U.S. Steel back in the previous Trump administration, as the administration was settling in 2017, you basically saw that it was a huge drop in the stock price of United States Steel, which carries the name of the industry in the U.S. And then they start talking about tariffs, and perhaps using tariffs to support domestic production. And then you see this huge rally in the price of that stock, perhaps indicated that investors are thinking that these tariffs might come, and that's going to benefit U.S. Steel. And they did come indeed on March 18th in 2018. They did announce the tariffs. And at that point, as an investor, you're saying, great, now I have tariffs. The government is fully behind this company, and that's going to be great for investors. It turns out not so much, because by the end of the administration, U.S. Steel lost the vast majority of its value. despite the fact that he had the backing of the US government. So it is interesting because tariffs don't necessarily translate into investment success. And it's possible that, these companies, might have had tariffs, but because now this price of steel increased, less was bought by the auto manufacturers or the machine, whatever, the washing machine companies and so forth. So maybe sales went down. Maybe there's customer service issue, product issues, implementation strategy, competitors. We don't know what happened, but the bottom line is that tariffs don't necessarily translate in success. And the last thing that I'll have to say, folks, is that it's quite interesting because when you look at the possibility of tariffs, some of these things are really unpredictable. What might happen? And one of the stories that I personally thought it was quite relevant to this is something that's called the chicken tax. And I'm not sure how many are familiar with it, but back in the 1960s, the US farmers were exceedingly good at producing chicken. And they were making the chicken, they were freezing it, shipping it overseas to Europe. And when chicken got there, it was really undercutting the local production. And in the case of the German farmer, they just realized, whoa, this American chicken is killing us. So they went to their parliament and they asked the representatives, like, you got to do something. And the German parliament said, okay, well, we'll put a chicken tax against the American chicken. And that's what they did. And the US government got all incensed, like, wait, we just gave you all the money for the Marshall Plan and now we're going to tax our chicken? That's not right. So the US government got a hold of the fact that VW was about to launch a pickup truck in the US. And they said, okay, well, you taxed our chicken. We're going to put a 25% chicken tax on all light duty trucks coming in the US. Have any of you ever heard of a VW pickup truck? No. The reality is that basically killed the whole thing. And what happened is, looking back 70 years, two things. One, it gave the U.S. auto manufacturers a huge competitive advantage in this particular pickup truck market segment, which carries to today. I mean, if you think of what names or what pickup truck names come to mind, like the F-150 and the Dodge Ram and Silverado, those are because the chicken tax is still in place with us today. So the first thing to tell you is that when we have these tariffs, the consequences in the short term could be bad for the German companies. It could be really good for the U.S. manufacturers over the long run. And with that being said, it's also possible that consumers are paying more. There are fewer choices, and perhaps it's not as good as it could be for all of us if we had free markets. But the second story is quite interesting, going back to those years, because when these tariffs got put in place, companies are not static. They're not going to just lie there and just take it and then just say, oh, yeah, whatever. I'm going to, like you told me not to bring pickup trucks. I'm not going to, or I'm going to pay 25%. They're going to get creative. They're going to get really creative. And a couple of examples from those days, one of them is Subaru. Subaru had a pickup truck called the Brat. It's actually called the Brat. And in order to avoid the chicken tax, what they did is they bolted a couple of seats in the bed of the truck, and they said, well, this is not a pickup truck because look, it has two seats in the back. People can stay there. I mean, this probably works in Oceanside, California. I'm not sure in Wisconsin it works as well. But the other one was Ford itself. Ford would make these pickup trucks abroad, and then, what they would do is they just bring in the whole thing without the bed. And they say, oh, it's just a cabin. It doesn't have a bed. It's not a pickup truck. And then they attach the pickup truck here and they try to get around it. In other words, companies will try to find a way to get around these tariffs. And it's been like this forever. And I don't expect that's going to change. Some more successful than others. But the bottom line is that even with tariffs in place, it's not going to be a clean resolution. It's nothing that is kind of obvious that's going to be good or bad. We're just going to have to wait and see.
Thank you, Apollo. I appreciate your insight. I know you've been at Dimensional for over 20 years, and I'm sure you've had this question multiple times. And so, over your 20 years at Dimensional, I would love to understand your thoughts on this topic. And also, I'm also curious if Dimensional's view on this has changed over your 20-year tenure at Dimensional. But it's where we are today. My question is around timing, around investing capital when a market is at an all-time high. And
Yeah,
clearly, we are here today. At 2 o'clock today, I printed off a list of stocks today that hit an all-time high, and the list was 125 stocks.
right,
Some of them we never heard of, some of them we have. But I think
right.
it's interesting to see that this stuff is happening, even though it may not be represented in an index hitting an all-time high. There are stocks hitting all-time highs all the time. And
Absolutely.
and interestingly enough, and we've been living in it for the past 10, 11 years. After the 0809 financial crisis, the market finally recovered in 2013. And between 2013 and 2021, before COVID, the market hit 38 new highs along
Mm.
that 8-year stretch. So
Right,
clearly, if you're waiting for a pullback, you missed out on a lot over an 8-year period.
right.
More closer to our current time frame after COVID, I'm sure it was really tough for people to take capital, and it was maybe a tough decision if they did. It was a good decision. Luckily for us, our investors are long term. They don't normally try to time the market, but there is something in the back of your mind at all times as to whether now is a good time to get in or not. That 8-year period between 2013 and 2021, those 38 times that it hit or stayed close to the all-time high was 15% of all trading days, which I thought was a pretty big number to think
Yep.
about. So anyway, that's kind of a long-winded opening, but I'd love to hear your comments and your concerns around market timing, especially around when the markets are at all-time highs. Thank
Yeah.
you.
No, I mean, I think it's such an appropriate question because we're hitting all-time highs, and frankly, like I like to know, like it's a legitimate question. What should I do? Because intuitively, what comes up must come down at some point. So, what do we do about this? And the first thing that I like, my first thought is as I first pondered this question, was that when you think of all-time highs. They're certainly happening in the market. The question is that terribly unusual? And when I took a step back and I look at life in general, all-time highs happen pretty much every day around us, and we don't stop and wonder. I mean, today we've hit an all-time high of how many people live on this planet, how many dollars are in circulation, how many gallons of milk we drink. All of these are all-time highs, and we just think, well, that's the nature of the world. There are more people, the economy gets bigger, everything gets bigger in numbers over time. So in that respect, I'm not sure that hitting an all-time high is necessarily something surprising, because as long as you have more people in society and you have more dollars in circulation, the size of the pie is going to get bigger. So I'm not sure that it's terribly unusual to see that. And you mentioned the past few years in the U.S. market, the S&P 500. If you take a look at this century, over the past 24 years or so, we have 24 years of data, and I thought it'd be interesting to see, as you mentioned, the years that have gone up and down. What's sort of the pattern that we observe in the market? And this is where it gets interesting. If you go back on the first 3 years of this century, we had 3 years of back-to-back-to-back negative years in the market, which is quite interesting. And then it was clear we had 5 years of positive outcomes, and then we had 2008. And there was a huge drop, about 37% in value in 1 year. And then we had another negative year in 2018 and another negative year in 2022. So if you actually look at the numbers, what you see is that 6 out of the 24 years, we had negative outcomes. So that's roughly 1 in 4 years are negative. And we had 18 out of the 24 years that were positive. And that's about 3 in 4 years are positive. So it's really interesting because this particular average holds up over the long run as well. It's pretty much the same if you look over the past 50 years or over the past 100 years. Is roughly the same. About 75% of the time in any given year, the market tends to go up, and about 25% in any 1 year tends to go down. So in that respect, there is no clear pattern to kind of say, is there a year that I know the market's going to drop? Things look really good. I mean, I have to say, in 2018, things were looking pretty good, and yet the market dropped. But it's also interesting to see that going back to the election, these are the last years of the Biden administration. 1 in 4 years was negative, 3 in 4 years, including this year, which is likely going to be positive. And then he had the previous administration that he had 1 in 4 negative, 3 in 4 positive, exactly the same. And they're going to end up with exactly the same averages, about 15% for the first Trump administration, the first Biden. And then the pattern of this is really not something that you can predict. Whether you look at politics issues or what happened over the past year, there could be 3 years in a row they're back to back to back, or you could have in this case 9 years of positive outcomes, and you can't really tell the pattern itself. That's the first observation. The second observation I want to make is that when the market hits an all-time high, I think there's a legitimate question on what do I do? And there are 3 options. There are 3 options that I have to say. The first option, I think it's the least appealing, and that is do nothing. The market's an all-time high, I do nothing. I'm not sure that that's necessarily always the best case. In some cases, and I'll come back to this, but let's just take this as one alternative. The other alternative is to say, this is a trigger of a potential drop in the market just because we've had so many stocks and the market's been running high. And then we know that afterwards, our expectation might be that the market might drop. And at that point, might we be better off selling, waiting for the market to drop and then come back in the market? And there's a third alternative that I'll come back in a second, which is somewhere in the middle, somewhere in between. So let's look at this idea that once the market, we kind of said that doing nothing is probably not the right option. But what about this idea that market hitting all-time highs might trigger a subsequent downturn? And the best way that we want to look at it is by exploring the data. Look at the numbers, not what we believe, but just be very, very rigorous in analyzing the numbers. And we have good data in the U.S. going back to 1920s. So here's what we did. We took every single period when the market went up. And then once we hit an all-time high, once the market hit an all-time high, we fast forward the clock by 12 months. And we want to see after that all-time high, if you look 12 months later, what happens to the market? How much did it drop? How much did it go up? What happens 12 months after we hit an all-time high? And that's a 1 year looking ahead. So when we ran that data, this is what we found, is that 1 year after we hit an all-time high, it turns out that on average, it turns out that the market continues to rally, which is quite interesting. After you hit an all-time high, on average, the market continues to do well, on average going up by over 13% annualized over that 12 months period, which is quite remarkable. Now, one can say, well, that's hitting an all-time high, and then you look 12 months later, but what happens if you invested any other month that is not plagued by hitting an all-time high? Well, it turns out that if you invested any other previous month, you still go up, but here where it gets interesting, by not as much. So it seems that hitting an all-time high should be a cause for cheer rather than panic, because on average, 12 months later, you are likely to see a greater growth in your portfolio on average. And these are averages, so they don't happen every single 12 months period after we hit an all-time high, but rather they happen about 80% of the time. And what's interesting is that if you look at any other month, it turns out that the market goes up, but not as often, only 75%. So it is so fascinating because when you look at the data, what this is really showing you is that hitting an all-time high tends to be a good thing for the market, as opposed to the conventional wisdom or the intuition that it might be bad. It's not that. And if you extend that to 3 years, what's fascinating, and by the third year, it just becomes a complete wash, whether in percentages or how often it happens. It just basically, it's exactly the same thing. So to me, when I look at data, there's nothing to suggest that I need to sell the entire position or wait for the market to drop, because in fact, the market continues to go up. And we also don't encourage this particular strategy for one other very interesting reason, and the reason for that is because when you decide to sell, there's an equally important decision that you ought to make at exactly the same time. When do you get back in the market? And over, we see investors basically missing out on any potential recovery and upswing in the market, just because it's impossible to predict both when to get out and when to get in. And much more often, what you're doing, you're replacing the stress of being invested with the stress of being out of the market. And the last reason I'll give you, which I think is really interesting, is that when you think about investing, the way I want you to think about it is the same way as you think about your own health. If you work out and eat healthier, there's no guarantee that you're going to live a longer lasting, healthier life. No guarantee. Just improves your odds. Everything in life is about odds, understanding data, statistics, and probabilities. Every single business decision that's being made today, from Major League Baseball, if you remember Moneyball, to corporate boardrooms, everybody's looking at data and making sure they understand the statistics of it. And why does this matter? Not too long ago, I was asked to present to a retirement community where they had an investment club, and that's exactly what they wanted to know. When they should get out of the market, when should they get in, and they watch the market every day and ask what else they do. I mean, watch the market all day. No, they watch the market in the morning. In the afternoon, we go play tennis. Anyway, but it was interesting because there's a set of statistics that really follow up on everything you've heard so far in terms of statistics and why it's important and not to get out of the market, but stay more disciplined. And if you look at the U.S. market, the S&P 500 this year or the last 50 years is pretty much exactly the same. On a daily basis, if you watch the market on a daily basis, what you see is that roughly 53% of all trading days in the market are positive, which means that 47% are not. And that's quite incredible because any given day in the market, it's almost a flip of a coin between making money or losing money. Those are just the odds. You have a little bit better odds of making money, but I can't say it's overwhelming. Maybe a little bit better, but not crazy, overwhelming in your favor. Now, if you are patient enough to give the market some time and you wait, let's say, for the quarterly statement, and you ask the same question over the past 50 years, what percentage of the quarters have been positive in the S&P 500? Well, that number jumps up to about 71% of the quarters being positive and only 29% being negative. So at that point, if you think about getting out of the market, oh, we hit an all-time high, you could miss a bad quarter, pat yourself on the back and say, great, I saved money. But in reality, what are you more likely to miss? A positive quarter. So you're kind of putting the odds against you. And then if you really want to wait for a whole year and wait for the annual statement, what's remarkable, as I showed you earlier, and in fact, over the past 50 years, the odds are even better. Than instead of 75, it's about 78% of the years have been positive and only 22% have been negative. So the more you give the market time to work for you, the more likely it is that you'll see a positive outcome. And because of that, again, it doesn't make sense to say it's an all-time high, let's sell everything and wait for the market, because whether you look at the percentages or whether you look at the odds, you're better off staying invested and not just falling victim to that seductive narrative that I ought to sell right now. Now, funny enough, I was looking at relating this to the other hobby they had, which is tennis. And it turns out there's a player that we all know. His name is Roger Federer. He's arguably the all-time best male player of all, and he retired a couple of years ago. And he's a gentleman. He's a great individual from what I've gathered. And I wanted to know, again, when it comes to statistics, how do you get to become the best of all times? And if you look at his statistics, Roger Federer, again, not an average player, the best of all times. It turns out that Roger won in his career about 54% of the points that he played, which put the other way, he lost roughly half the points that he played. If you watch Roger Federer play a point, it wasn't obvious that he would win it. He lost roughly half the points. But what he did, he played all the points, he won the big ones. And if you ask the question, well, what percentage of the sets did Roger win? Well, he won about 75% of the sets. And if you really are patient enough to wait for the whole game, you realize that he won about 81% of the matches that he played. And the reason I think it's so interesting is because these statistics align incredibly closely to the stock market. Whether you watch Roger Federer play a point or the U.S. stock market any given day, the odds of seeing a positive outcome are roughly the same. But if you give Roger, time. If you give the market time, the more time you give Roger, the more time you give the market, the more likely it is that you'll see a positive outcome. So it's not about saying I need to, make money in the market every day. I just need to play all the points. And the more time you give markets, the more time you give Roger Federer, the more likely to see a positive outcome. And that to me is a key to becoming a successful investor or a great tennis champion. You just have to be there and play all the points. So we talked about this idea that do nothing, which again, I don't know that's the right thing to do. The second one is to sell everything because there's a doom impending, and I don't believe that's the right thing. But there's a third thing that you could do. And this is what advisors typically pay really close attention to. If you have a balance, for example, between stocks and bonds, and we talked about stocks and bonds as being the two fundamental pillars, and the stock markets are going up and up and up and up quite significantly. Well, if, for example, you were supposed to have a balance of half stocks, half bonds, as the stock market grows and grows and grows, the percentage that you have in stocks is likely to be greater than your desired allocation. So if you're supposed to be 50-50, you might go to 58% in stocks, which is much more than you want to have. So at that point, an advisor analyzes whether or not this is the right time to trim some of those gains, take some chips off the table, and go and do something called rebalancing of the portfolio. So you can bring it back in alignment to what your desired allocation is. And that to me is something that absolutely makes sense to do, is sell a portion of it at the right time, depending on the advisor evaluating the taxes, the costs, the benefits of this. And then, most often what we see advisors do is that they consider a trade every single day. It's just most often the best trade is not the trade. But there are times when you want to rebalance the portfolio, and you have to be very careful and very systematic about this. And that's what I would suggest, in my opinion, as a good course of action. Have an advisor pay attention to your portfolio. Market hits an all-time high, another all-time high. At that point, they might, at intervals, trim some of these gains. At that point, you're not that exposed to a market that might go down.
Hi, Apollo. It's Sean Williamson.
Hi, Sean.
Good to see you again. We appreciate
see you too.
Having you back this evening. So one of the questions that we often get from clients is something along the lines of, why isn't my portfolio performing the same as, let's say, an index like the S&P 500?
Yep.
And we've had long periods now where international, large and small, emerging markets, even U.S. small caps have underperformed the large growth stocks here in the U.S. So how would you, what would you comment as far as if somebody just said, hey, let's ditch diversification and just invest in this segment of the market that's done so well for so many years?
Yep. Oh, and you're absolutely right. I mean, I think that it's so fascinating that you brought this up, because even if you look at the different metrics of the market, they are quite different, and they're different than what a portfolio might do. So let's just take the first half numbers, and I'll to kind of completely make your point. If you look at the first half of 2024, and you look at the S&P 500, let's start with the most commonly used metric, and that's the Dow Jones Industrial Average. And for the first 6 months of this year, the Dow Jones was a little bit below 5%, but let's just say 5% for simplicity. That was the growth in the Dow Jones for the first 6 months. Now, the S&P 500 was up about 15.3% for the exact same time period, so substantially more than the Dow. And NASDAQ was up 18.6%, so let's just round it up to about 19%. So the reason I bring this up is because if you look at a globally diversified portfolio, well, that number would have been closer to somewhere between the S&P and the Dow, rather than closer to NASDAQ. So I think it's really important to touch on this. So, how should you think about it? Are you missing out because you're not getting the great returns in the S&P or NASDAQ in a global portfolio, or in the Dow for that matter? So the way to think about this is that the S&P 500 being up about 15.3% for the first 6 months is a collection of 500 different companies. 500 different stocks, each one of them with a different return. So how do we get from 500 stocks to just one number? Instead of averaging them out, which might be the easy way to do, what the S&P does is something a little bit more clever. It basically says that we're going to look at the size of the company and what's the value of ownership of each company. And the larger the company, the more meaningful it is in the market, and the performance of that company is going to be greater. So in that respect, the larger the companies, the greater the impact that they have on the performance of the S&P. And the largest 7 stocks in the US market are the usual suspects: Apple, Amazon, Microsoft, Google, Nvidia, Tesla, and Facebook. And when you look at these 7 companies, they actually got a nickname. They're called the Magnificent Seven, because if you set them apart for the first 6 months, remember the S&P as a whole was up 15% or so. These 7 companies on average were up a whopping 36.9, almost 37% on average between the 7 of them. So they had a phenomenal performance for the first 6 months. And the remaining stocks, they left a hole in there. The S&P 500 minus the 7, the S&P 493 was also up, but a much more modest and much closer to the Dow, 5.1%. And the reason I think it's so fascinating is that these 7 companies, which are giants among giants, somehow lifted the 15%, even though there are only 7 stocks. Well, how come? The reason for that is that these 7 companies combined amount to about 32% of the value of the entire S&P index. About a third of the performance of this entire S&P index comes from 7 companies. And what's so fascinating is that the same exact 7 stocks are also in the NASDAQ. But instead of 32%, a whopping 54%. 54%, more than half of NASDAQ is in 7 stocks. More than half of the performance of NASDAQ is driven by 7 companies. And if you look at the US market, they're not only large companies, but there are also some smaller companies, which are also part of the market. And if you look at that market metric, that one also includes these 7 stocks, but in a smaller proportion, because you're now diversified across 3,000 stocks instead of 500. And from a global perspective, you absolutely can have them in the same metric, like of a global allocation, in this case, the MSCI World Index, but instead of 54, 32, or 28, only at 18%. And I think this is so fascinating, because what this is saying is that if you look at the performance of these different metrics of the market, I have a good sense of why are they different. If you are in a global portfolio, you're not missing out on these, large tech stocks. You're just not as concentrated as you would be in a Nasdaq. And in a year when these 7 stocks are doing well, guess which one of these metrics is going to look stellar? And in fact, if you go back to 2023, NASDAQ, which is so heavily concentrated, last year was up 44%, 44%, because you was concentrated in these stocks, which also did well last year. And that's why a lot of folks are saying, well, listen, why do I need all this nonsense? Because these 7 stocks are the one crushing it. They're going to do no good, no wrong, and whatever. Well, let me tell you, folks, if you take a single step back, go back to 2022, one single year back, what you see is that the same exact NASDAQ that had about half of in these 7 stocks was down almost a third in value. Just a huge drop. And if you have this big concentration, you can either make a lot of money or you can lose a lot of money, which is not ideal for a plan. So what if you had the same exact stocks, but instead of half, you would have them at about 15% over the past 2 years? Well, here's where it gets interesting. The first thing that you see is that you don't have this wild swings in your wealth. You take away the extreme outcomes, which can be an amazing benefit to an investor, not to have to deal with these extreme outcomes. But the second thing is that if you look at performance, NASDAQ, even after being up 44%, it's still on the water over these 2 years. It hasn't recovered because, folks, if you start with $100, and I'm just going to use a simple example, and you drop by 50%, by the end of the year, you would have $50. If you now start with $50 and you just want to get back to 100, it's no longer enough to go up by 50%. You have to double, meaning you have to go up by 100%. So when these stocks are dropping by 32%, they need a lot more than 32% to come back to where they used to be. And that's why you have this number that's negative. And when you look at this global portfolio that you say, oh, this is terrible, you know, it did half of what NASDAQ did. Over these 2 years, this global portfolio not only avoided you these extreme outcomes, but it actually outperformed NASDAQ, So to me, it's really important for an investor not to get caught up like these are the 7 stocks and they're going to rule the world. It's possible, but you're exposing yourself to a lot of risk. And we've seen this exact same pattern. 21, they did amazingly well. 22, they did terrible. 23, they did well. This is not a clear pattern that they always do well. Now, you also mentioned international, and why is it that that we want to put some money in international stocks? And I have to say that the U.S. companies, if you add up Microsoft and Apple, all these magnificent 7, plus Coca-Cola, McDonald's, Boeing, you name it, all these companies we love, and the smaller ones in the U.S., and you redraw a world map where you plot the value of different companies that you can buy and sell around the world. Where it gets interesting is seeing that the U.S. is the largest stock market in the world. That these 3,500 companies or so amount to about 60% or so of the value of all companies that you can buy and sell around the world. And remember, these are countries, but you're not investing in countries, you're investing in companies. And you're looking at the value of different companies. So in the US, you'd have Ford, GM, Tesla. In Japan, you would have, for example, Toyota and Subaru, and in China, you would have Volvo and BYD and Lotus. In India, that's Range Rover and Jaguar, which are owned by an Indian company. You certainly are familiar with the Mercedes, the BMW in Germany. So in other words, these are companies in which we can invest in the same way that we have local car companies are all over the world. And there are roughly maybe about 10,000 other companies around the world that you can buy into them. And right now, the U.S. is a very largest stock market. It's also an amazingly strong economy. It's the envy of the world. We have these technology stocks, and we've had phenomenal performance over the past decade in the market. And that's kind of what we're hearing investors saying, maybe put more money here at home. And the first note on that is that, you know, when you construct an allocation, when an advisor constructs an allocation, it's not about putting everything at home or everything abroad. It's more or less, let's look on a relative basis. And on a relative basis, the lion's share, the vast majority of the money would be invested in the US. And then the second largest stock market that you would have in your portfolio is going to be Japan. And Japan is going to be 1/10 of the value of the US market. So we're not talking about going gangbusters in all these countries. It's rather find a proportional allocation based on the value of companies that you can buy and sell. And I'm going to maybe kind of like finish up with why I'm such a believer in global diversification by letting you know that in December last year, I was honored to be invited in Tokyo to speak to Japanese families who wanted to get a sense of how investing has evolved and what are investors doing in the US. And it was fascinating to meet with them. A lot of older families and quite wealthy. And as I met with them, they're very skeptical to invest in the stock market. In fact, they're very reluctant to do any investing outside of the post office, which is the main way that they invest in Japan. And I try to understand the reluctance. Where does it come from? And a very interesting story emerged that has relevance for us today. A lot of these families started investing when in the 80s, as they started to build some assets in the 80s. And in the 1980s, the Japanese economy was the envy of the world. I mean, they owned so many things in the US. And my dad gave me a book saying, son, learn Japanese because that is the language of the future. Everybody's going to speak Japanese. And they had these incredible technology stocks of the day. I mean, you folks are too young, some of you, to remember, but in the 80s, the big thing that everybody wanted was the Sony Walkman, the Sony VCR, the color TV, the Toshiba. Anything that was quality electronics in the world was made in Japan. these companies were unstoppable. They're a Nintendo. I mean, there are so many amazing products and companies that came from the technology stocks of the day in the 80s in Japan. And they could do no wrong. They were selling everywhere. And because of that, what's incredible is that in the 1980s, the Japanese stock market actually did better than the dot-com boom in the 90s in the US. 1 yen increased sevenfold over the decade in the 80s. And because of that, what's incredible is that their stock market in 1990 was significantly bigger than the US. The Japanese stock market was 41%, the US market was 30%, which is incredible. But the reason I think I want to bring it back home to us is that those families in the early 90s are like looking and saying, look, we have an economy that is the envy of the world. We have some unstoppable technology stocks. We have had amazing performance over the past decade, and we are the largest stock market in the world. Why would you want to put money anywhere else? Let's pile all the money in Japan. And that's exactly what they did. And it took them about 30 years to recover those losses. So to me, when I hear pretty much exactly the same thing, by no means am I suggesting that's the path of the US market. I'm just saying that things change. And you want to keep up with change, and just in case things change, and you want to make sure that you're not caught flat-footed as those families were in Japan, because they lack this global diversification. So because of that, I truly believe that a portion of your money should be invested abroad, and an advisor and a client can really benefit from having the global diversification and not take an unnecessary risk, even though there are a lot of things that might just say, well, that looks really good right now in the US. Things change.
Thanks for that, Apollo. I really appreciate you saying that you think we're too young. Not true, but appreciate it nevertheless. I do remember the 80s very well. We don't have that much time left, but what I was hoping you can maybe speak about for a few minutes. There's a lot of questions that we get from clients, and there's been a lot of press regarding cryptocurrencies, Bitcoin in specific. And so maybe you can spend a few minutes just speaking about that, and really the question of, does it make sense to invest in Bitcoin or cryptocurrencies or not?
Yeah. So that's a really big topic. So cryptocurrencies came along, and Bitcoin being the first one, back in the 2009, just around the time when we had the financial crisis, where people were skeptical of the financial system and banks and so forth. And this anonymous person or group of people, they had this idea that, what if we actually create a way to move money that has some really interesting features? And the first one being that instead of the one bank kind of keeping a ledger that they know the ledger and nobody else does, what if we create a ledger that is shared among so many computers? It's open and transparent. Everybody sees what accounts have what money, and that is called the blockchain. And there was a very interesting technology that allowed to keep track of ownership in a very transparent way, but also be able to move money, and the money here being a token that they called Bitcoin, from one wallet to another. So in that respect, it was a very interesting, very avant-garde and forward-looking idea to create this system where people can transact. And that's why it's called a currency, because they can transact and they can exchange these coins without the government being involved and without needing to rely on the trust of any one individual, because that blockchain ledger is visible to everyone. And the unit of account in that respect was the token was Bitcoin. Now, if you fast forward 15 years later, it turns out that Bitcoin, it is certainly not a currency. Because the currency, it needs to be something called medium of exchange. In other words, people want to exchange it, and you want to basically go buy milk with it and be accepted at the gas station and be accepted at your grocery store. And that's not the case, certainly not the case. It's not people transact in dollars. I mean, let's just be realistic. Unless you're buying drugs or you're some sort of a terrorist, you're not dealing with Bitcoin. You're not using Bitcoin to buy things. Just be very clear about that. The second thing is that it is not a unit of account. In other words, prices are not quoted in that. And then the third reason is that it fluctuates quite a bit in value, much more so than prices. So any given day, you can make a lot of money or you can lose a lot of money in Bitcoin, whereas the prices at the grocery store, they tend to be very stable, whereas this is not. And that's a feature of a checking account. The value of what he can buy today is roughly the same what he could have bought yesterday and probably tomorrow as well. So it's not a currency. So then what exactly is Bitcoin? Well, to me, Bitcoin has become considered an investment. And in that respect, it's very different as an investment than stocks and bonds. And it's not the fact that it's new or it's got a limited availability. What's interesting about stocks, bonds, real estate is that if you buy them, there's some productive activity that allows you to figure out if it's a good deal or not. If you look at Apple, I know they're selling phones, they're making money off iPhones, and I can make an assessment of like, okay, how much money do I think they're going to make? And then if I buy a share of ownership, is it a good deal for me to buy at that price? Because I can see and I form an expectation based on their productive ability. They have real people, real products, real profits. When you look at Bitcoin, it just doesn't produce anything. It has no productive capacity. So the value of Bitcoin is not driven, in my opinion, by any economic fundamentals, but it's rather driven by sentiment, how people feel. And I think that if you look in that respect, I'm not sure that's the greatest basis to make an investment decision. And I'm going to share with you, just the way that I look at it. It is something that you believe somebody else will pay more in the future. It might happen. And an example of this is if you look at on eBay, back in August at the Dodger Stadium, they released some bobbleheads for this great baseball player from Japan, Shohei Ohtani. And as they released those, you went on eBay and it was $1,500 for a bobblehead. And this is a bobblehead. It's just like it comes in a little box and it's $1,500. And some people bought it speculating that on sentiment, this is going to go up in value. And lo and behold, it did go up in value to about $20,000 for that figurine, which again has no practical purpose. You put it on the desk, it doesn't do anything. But yet on sentiment, they believe that's going to go up. And it did go up to 20,000. But it's also true that it came down to less than 1,000, which is something that could happen with Bitcoin as well, because again, it is not driven by any economic fundamental. So the first thing that I have to say is that we don't understand what drives the returns of this except for sentiment. And because of that, I couldn't recommend it because I don't know if it's a good deal or not. Secondly, when I look at the risk associated with this, it's absolutely tremendous. When I looked at the numbers lately, the US stock market fluctuates more than 3% gain or more than 3% loss about 1% of the time on each side. So about 1% of the time, you make more than 3% in any one day. 1% of the time, you lose more than 3%. So in other words, extreme. It's very extreme to see these outcomes. With Bitcoin, it's about 10 times as often. Over 10% of the time, either you make more than 3% or lose more than 3%. In other words, it is so magnitude of risk greater than the stock market. So again, from a risk perspective, I have a hard time recommending it to somebody. And then the last thing is that if you were to include this, you have to say, well, okay, how much am I going to put in this Bitcoin? And if you look at the value of all Bitcoin as a whole, in the last I checked, it wasn't it was great as even one of these magnificent seven, let alone all the stocks in the US, let alone the global market. So the fraction that you would put in Bitcoin would be so tiny that ultimately the question is the juice worth the squeeze? Because it's not going to make a meaningful impact if you put it relative to the value of everything else. So because of all these reasons, and because even from a custodian perspective, and who keeps track of these, it's not very clear there's a robust solution. I actually don't think that they really tremendously help in any way clients achieve their financial goals as part of the financial plan. And the only suggestion I had is that if you really feel that emotionally it's good for you to own it because you don't want to miss out, you want to be part of something new, do it the same way that you do it for the the good old bobblehead. Just own it and say, hey, if it goes up, great. I just don't, I wouldn't put my retirement money on that because you never know. It's a sentiment-based investment. And because of that, I think that if you want to do it just because it says something about you, you don't want to miss out. Maybe taking some money and putting it in there, it's not the end of the world. As long as the financial plan is steady, and that's what you would rely on to achieve your financial goals. And for that, I don't think you need Bitcoin.
Well, Paulo, thank you so much. I kind of threw you a hand grenade there with not that much time, a topic that we could probably easily spend an entire
Oh,
webinar on. So I appreciate you. You covered it you really well, I thought. Thank you again for spending the time with us and answering these questions. I know that our clients gave us great feedback on the last webinar, and I'm sure they will again this time. So again, thank you so much for your time, and thank you everybody for attending this webinar. Have a good night.
bye-bye.